Hi, I'm Leslie Koo. The US and Iran, no deal, no agreement, and also no opening or confirmed reopening of the Strait of Hormuz. What that means is that market sentiment, the traders, buyers, exporters, they continue to be nervous, cautious, panicky, because anything can happen given the current situations. On maybe now the attacks on Iran by the US, or the US said that, well, we have reached an agreement with Iran, but the next minute, Iran said, oh, no. There isn't any agreement on whatever terms and conditions. The Strait of Hormuz remain closed. It's still what Iran says. We say you can go through, you can go through. It's still, we say you cannot go through, you can go through. It's still this kind of situations, this kind of conditions. In general, the market sentiment for this week will be the same. Cautious, nervous, and panicky. And what this means for the oil market. Okay. The general sentiment for the oil market will continue to be panicky, cautious, and market participants, the traders, buyers, importers, exporters, so on and so forth, will continue to monitor very closely. And that means this is a baseline. And the probability for the price to be above the baseline and below the baseline carry equal weights. Because given the current conditions, environments, sentiments, it goes both ways. The force to push the oil price up above $100 per barrel carry the same probability for the oil price to go below $80 per barrel or $70 per barrel. So this carry the same weight. And what happened to I always talk about the biasness, right, for this week. I would say the bias is still towards the upward momentum of the oil price, because it is very unlikely that we can see a very high probability for the oil price to plunge, like return to normal to $60 per barrel. Now, for this week, given the current situation, it's not going to happen. So I would think that my assessment is that the risk is still biased to the upward momentum of the oil price. But one thing to highlight about the oil prices is that we've seen China, if not the biggest, is one of the biggest oil importers of crude oil. Since since April, you can see that the crude oil imports have dropped a lot, and it hasn't gone up from April to July. So if you count by the millions barrel per day, on average, China has imported 4 million barrel per day less compared to the normal time. And this 4 million barrels per day, it means a lot for the pressure of the global oil market. And that's why I will see that. And by the way, for the reason why China is able to import less oil and continue to keep the economic engine running, that is the topic which I've discussed in my previous video. So for this one, let's back to the oil price. for this 4 million barrels per day reduction from China, I see that it has kept the pressure on, or rather the upward momentum on the global crude oil prices more or less intact. There hasn't been any up boost for the price to head towards like $100 per barrel, $120 per barrel, $130 per barrel, the kind of things, like what the global research team has forecasted, at the onset of the US and Iran war. So this is one thing that we have to take note of, the huge reductions of China crude oil imports. Now let's look at the gold price. This is the baseline, and I would say that the probability for the gold price to be above the baseline and below the baseline also carry the same rate, because the current the market conditions, be it the inflation, the demand for US dollars when the oil price head up. So these forces keep the probability above the baseline and below the baseline very much alive. They carry the same weightage. And one thing is that the the inflation related hedging momentum will continue to be there. And one thing to highlight is that no doubt the global oil price has come down, but the domestic oil company, they're very sticky in adjusting the domestic oil price, for example, petrol, diesel, so on and so forth, lower accordingly. So the inflation rate is still there, and people in general will buy gold to hedge against the purchasing power. So that's why we still see that there's a demand for gold for this week. And of course, the central banks around the world, especially China's central bank, will continue to buy gold, to power up their gold portfolio. And if you look at the latest China foreign reserve, the gold reserve has gone up again. So when the gold price falls below, or falls to around the 4,000 ounce, $4,000 per ounce. Sorry. So when you see the gold price fall to around the $4,000 per ounce, well, you can see the demand, the buying interest will start coming and keep the prices from falling way below the $4,000 per ounce. So for this week, this will continue to happen. This kind of support for the gold price will continue. And in general, the sentiment for oil price and the gold price in general will remain very cautious, very volatile, and we should see that the traders, the buyers, the oil exporters, oil importers, gold buyers, so on and so forth, will remain cautious, and that will reflect on the prices for these two global commodities. That's all for this video. Thank you for watching. See you in the next one. Cheers.